Good morning, everyone, and welcome to today's virtual brunch on the U.S. markets in advance of the presidential election. My name is Darren Marsh, and I'm an associate in the Toronto office. Moderating today's call is Andrew Garshigan, a portfolio manager and partner at Pembroke Management. Andrew joined us in 2016 after spending 11 years working in New York for long-short hedge funds and is an important part of our portfolio management team. Also, with us all the way from Newport Beach, California, we have Jim Fury. Jim is the founder and managing partner of Fury Research Partners. Founded in October 2008, Fury Research Partners provides comprehensive small cap strategy, company research, and idea generation to its institutional clients, including Pembroke Management. Jim's firm has twice been recognized by Institutional Investor as the #1 small companies research firm in America, and we're thrilled to have Jim with us this morning. Jim last spoke with Pembroke clients in May of this year. That video is available on our website, www.pml.ca, and if you haven't had a chance to listen, I encourage you to go to the website and watch. Some clients may be connecting today by phone and others via the internet. For those of you connected via the internet, please submit any questions by clicking on the Ask a Question button on your screen. It should be in the bottom right-hand corner. Thank you all for joining us. Without further delay, I'll pass the mic to Jim.
Thank you very much, Darren. Let me share my screen. Just want to make sure that I do this correctly. Okay, are you seeing my screen? Terrific. Well, thank you very much, Darren. I appreciate it, and thank you, Andrew and Ian and all of my friends at Pembroke. It is an exciting time in the markets, and it's an exciting time in the world of politics and economics, and there is a lot to consider. The topic that we'll address today is one that is front and center for all investors, and that is, will public venture capital and growth lose its dominant small cap position? This is a topic that everyone is wanting to discuss. And my conclusion, and we'll walk through how I get there, is that it is not going to lose its leadership. People are scared of change. People want change sometimes. But as we'll see, the demographics and market and policy outlooks do not present what I think is a compelling case for change. But that doesn't mean we're not monitoring it. That doesn't mean we don't understand how it can happen. So we'll talk about that a little bit too. There are a lot of slides here. We're happy to share them. I'll hit on some and I'll go quickly over others. Let's start with some quick insights. And the thought here is that we'll have about 30 minutes for Q&A. As I referenced earlier here on page 5, it is a time of political, social, and market complexity. It is also a time of potential change. And what has happened is that the pandemic has accelerated a lot of trends. It has certainly created tensions in economies, in political systems, in institutions, in how they work. And the investors that have been positioned for an online and intellectual property dominated world have done very well. But what it's done is created a lot of uncertainty as well as to what I would call an event path, how markets and economies might interact. Certainly the US election has compounded that because there are so many different paths. If we have a divided Washington with one party in charge of the White House, another party in control of Congress, or if that's split. So what's happening in this time of complexity and potential changes, we're finding that investors that we speak to are trying to stress the inputs to asset prices, and they're fearing change because the policies and economies in place since 14 have been so dominant. So the point I would make in rolling out these quick insights is that small caps are cyclical. They correlate with rising interest rates and high nominal GDP, and that's also true of value. Growth inside of small caps a little less so. So let's make some other points. First off, ignore the political rhetoric. Much of it is designed just to get people angry and to get voter turnout. Focus on policies, what it does to growth rates, interest rates, and inflation. And if you think quite simply that an investor's chore is to find the best relative earning strength inside of the market, and then to identify the most favored duration of asset that you want to own. Long duration if they're low interest rates and low inflation, or short duration if there's high inflation and high growth. Then you can view the lens of policy choices most accurately, and you can sleep a little better too, understanding that the rhetoric is there to get voter turnout. One thing we believe is that the markets are smarter than any one individual, and that there are messages in market internals, market interactions, and that policymakers are trying to influence markets, and in the case of the Fed, quite successfully. So we'll go through what markets are telling us as well. One thing is clear in regards to policy and quick insights, and that is that the Fed, along with the ECB and the Bank of Japan, has doubled down on zero interest rate policy, quantitative easing, and it is forcing investors out the risk curve. What it also, though, is an admission by what is generally thought to be the world's deepest economic group, is that it is very difficult to generate organic growth and inflation. So this is the world we live in, and sometimes the most powerful messages are those sitting in plain sight, and I would say this is one. While talking about zero interest rate policy in the Fed, and we'll continue to reference this throughout, it's just worth noting that the Fed is probably the world's most effective major governmental organization in the world. And it is highly functioning and effective precisely because it's so confident, small in its decision making, and unified in its thoughts. And it is dominating not just the US, but it's dominating the world central banks, and accordingly the world's policy. So it dominates every investor's decision. It also dominates the policy makers on a fiscal front because, for example, the central bankers' willingness in Japan, in Europe, and the US to openly state that they are there to provide support for extreme fiscal policy is a very powerful message about the growth we can expect and the interest rate regime that we're going to be living in. Because if what an investor does, as I started to talk about a minute ago, is identify the best relative earning stream and the most appropriate duration asset to own, the Fed is telling us it will be a slow growth market, and with low interest rates, long duration assets are what you want to own, and that is a growth market. Let's get into some more detail. What we're going to try to do today in the detailed section is give you some detail around what the environment we're operating in. And these are things like demographics and policy. And these are the things that are very difficult to change. And in fact, they shape the economic growth that is being produced in the US and around the world. And then we'll talk a little bit about risk. So let's talk about the environment. graphics. And this is something that isn't considered explicitly often enough. And when you talk about the potential for growth, GDP growth, there's a simple equation that people don't talk about enough. And that equation is that GDP growth, real GDP growth, equals population growth times productivity. So the point that we make in this slide, which is so important, is that we have aging demographics in the US, but also in China, in Japan, and in Europe, the entire industrialized world. So to a certain degree, to a very important degree, no matter what policymakers do, they are in the face of declining population, trying to get nominal growth. And here's one of the key kickers: that's strong enough to provide for the social safety net that has been promised in the US, Europe, and Japan, less so in China. But when you have an aging population that is supported by fewer workers, it creates a very strong sense of urgency in the part of policymakers to get growth higher. In addition, it creates urgency to create financial asset prices and real estate prices that are high, because the retirees' financial future depends on it. Now, it is also true that the financial systems, a decade on to higher asset prices, and that includes not only banks, but insurance companies and the shadow banking system, are also important on it, depending upon it. And lastly, tax receipts are depending upon it. So this is one of the reasons why every time there's a slowdown or a market correction, the Fed and the central bankers around the world come and ride to the rescue. Now, you can argue whether this is right or wrong, but what is more difficult is to argue that it's not going to happen. And in fact, every time we see a crisis, it does. So let's dig into a little bit more detail on demographics, because it's so important. So a total fertility rate of 2.1 gives you a population that is flat. In the countries that we look at here, which is US, Germany, Italy, Russia, Japan, China, the average fertility rate, total fertility rate, is 1.6, which means that the populations will shrink over a lifetime by 24%. But if you look at Italy, if you look at China or Japan, they're at 1.3. That implies a 43% decline in population over the course of 70 years. So how do you grow? How do you keep real estate prices higher when this occurs? Well, the answer is you print a lot of money. Demographics, as people age, and you can see on the left here, over 20% of the US population is over 65. You spend less. The curve on the spending is to the right. But here's something that is less well understood, and we've talked about this with you in the past. And that's to say, as you age, if you don't have any return on the savings that you have because you're living in a zero interest rate policy, a paradox of thrift is created where you save more and spend less, which keeps growth lower. So let's put a little handle on the demographics. The working age population in the US is actually now shrinking. And this is true of Europe, Japan, and China. So how do you grow GDP when there are fewer workers? Well, you do it with capital spending, but that's not as easy as you might think. It is interesting to see that the velocity of money, how quickly money turns over an economy when reserves are created, has been declining ever since the population, the working age population, peaked. What this means is that the effectiveness of money to generate growth, low interest rates to generate growth, is declining. So you have to print more money. It means the central banks keeps rates lower. This is a trend that started back in the 90s. What are we seeing in terms of central bank balance sheets? Well, we have seen an explosion in the Fed buying assets. It's now left-hand scale over $7 trillion. And the central bank has grown its balance sheet by over $3 billion just in the last 6 months. Now, this has a lot of people worried that inflation is going to occur as a result of this. I am not part of that camp because this is replacement for a 30% run rate decline in GDP. So that's a $7 billion run rate decline. If you take half a year, it's about $3.5 billion in lost GDP. Oh, happens to be about the same amount of money that the Fed put in the hands of markets and consumers. But this is an important number on a number of fronts, one of which is that when the Fed buys the debt, and we'll talk more about this in a minute, it effectively retires it because the interest costs of the debt get sent back to the Treasury. But this is one of the world's most important numbers. Now, when the Fed prints all this money, there is a cost, and the dollar is the primary victim. The dollar has been going down about 7% since the March peak. And if we continue to see extreme monetary policy in this order, expect the dollar to go down and also expect growth to be difficult to achieve. Here's the point we made earlier. We'll go into a little bit more detail. When the Fed buys the US government debt, it retires it. So if the US GDP is about $21 trillion and the Fed has $7 trillion of assets, you can take that away from the Fed's, from the US government debt. So instead of US government debt being at 140% or 135% of GDP, you bring it down to 100%. It's an entirely different situation when you look at total leverage. Now, the world is figuring this out, particularly politicians, and this is most commonly referred to as it evolves as modern monetary theory. And the argument that they are espousing is that the Fed can buy the debt, there can be no ramifications. And so what we're going to see is the ability to be able to run extreme deficits without an impact. Well, we already saw that the US dollar is impacting, so it's not necessarily 100% true there'll be no impact. But what I would say is that this is a powerful tool, and it makes it important to take that more subtle view of what's going on with the debt. Let's start to move a little bit more quickly through some of the market insights. Remember how I said markets are smarter than any one person? Well, there's no more important market than the bond market. And it's clear that the Fed and the ECB and the Bank of Japan are influencing markets, particularly in the short run. But if you look out at 30-year bonds, which is in the lower box and in the green line, or 10-year bond yields, which is the blue line here, or the spread between the two, which is in the top box, there is an important message about growth and inflation that is implicit. We are at 38-year lows for interest rates in this chart, and many argue 500-year lows for interest rates. So the Fed is clearly influencing it, but the further out you go, the less they're influencing it. The point being is that the growth expectation and inflation expectation is very muted. So if our topic today is how does growth do versus value, The interest rate and inflation environment says very clearly that growth will be difficult to achieve and inflation will be low. So where you can find growth, buy it, and long duration assets are going to do well. Now, the yield curve, let's spend a minute here. The yield curve is steepening on the 30 minus 10 year. Notice that this occurs into recessions and after recessions. We are just, we're about 2 years into a steepening here. What this tells me, because the steepening is occurring as it did in the earlier recessions as 10-year yields collapsed, is that it is not an all clear sign for cyclical growth, for value. So it's reinforcing the point of the yields and inflation implicit in 30 and 10-year bonds that investors believe that growth will not be accelerating in the next forward period, the 10-year period. Now, how about inflation? Here are, and I apologize for the size of this, this is TIPS bonds, Treasury Inflation Protected Securities. Basically, they've stopped going up since July. The TLT, which is an ETF for long-dated Treasury bonds, has been going down modestly. When interest rates go up as a result of bond prices going down, that's bullish for stocks and particularly small caps. Down on the bottom right, we see the spreads between treasuries and the TLT, and it's rising. This is a perfectly coincident indicator. Because it trends, it's very important. And it's not only heading up, but it's broken out. That's bullish for stocks. And you can see the Russell doing better. We know what large caps have done. But the point would be is that inflation expectations are under control and it's a bullish indicator. One of the other things we've looked at, and I apologize for the squiggly nature, you can spend time looking at this later, is that real interest rates, in other words, the level of nominal rates minus inflation, is very low and the Fed's been keeping them negative. That is an implicit bet that growth will not be high. And in fact, you have to ask yourself, with basically 10 years of almost always on negative interest rates, how come we haven't been able to generate strong growth? Well, it's because of the demographics, and I think full balance sheets where everybody but the federal government, a decade into zero interest rates, has borrowed on the margin the money that they want to. But why this matters for a small cap investor is because small caps do well when real interest rates are rising and they outperform large caps. We are currently in a period where they've been falling, but I think we're ready to get a rise. Growth versus value, the point of our call. This is a monthly view going back to 2000. Growth is strongly outperforming value. It's been occurring ever since the great financial crisis. But notice, for those that think this is ready for a mean reverting bounce, we're not back to the level that we reached in the internet bubble. Here's a look on a weekly basis, and I talked about how the market is debating whether or not cyclicals and value are going to outperform. Growth and value have been battling it out subsequent to the May-June period. And I think it's a fair discussion. And that's why we're having it. But let's look at growth versus value going back to the 1920s. Value outperformed growth for 65 years. Growth has been outperforming value for 13 years. This is updated through the end of September. What are these periods of growth outperforming in the 20s and 30s, then value outperforming for 65 years, and now growth outperforming again? What is the lesson this chart tells you? Well, value outperforms growth when there's high GDP, higher inflation, high earnings growth for companies, and 10-year yields are higher. That's why I reference so strongly the GDP equation, which looks like because of population growth, it has to be low. And I talk about inflation and interest rates. It is the setup where growth outperforms value because, again, it's where the relative earning strength will be in the most appropriate level of interest rates. Let's make a very important point. When interest rates are close to zero, it has an unintended effect when you do it for a decade. It drives the return on invested capital towards zero. But another way of saying return on invested capital is a return on assets, which is another way of saying a return on equity, which is another way of saying return on savings. So if everything is trending towards lower returns, who's making the money? Because we know there are areas of the economy that are making great returns on invested capital. Well, when you look at the commonality, it's the companies, people, institutions, industries that have intellectual property, which, by the way, is easily measured in regards to gross margin, regulatory advantages, which keep out competitors, and network effects, which also keep out competitors. Now, this is best seen in areas like healthcare, where there literally are, for drugs, 17-year periods of exclusivity, but it also plays out in technology and other industries. The point being is, as an investor, when you look at where wealth will be created, what you want to do is identify companies inside of sectors, inside of industries that are best positioned with intellectual property, regulatory advantages, and network effects in order to be able to outperform. Let's move on for a bit. What about small cap valuation? Is growth too expensive? Is value too cheap? Well, here's a look at the median PE of the Russell for profitable companies going back to the 1980s. Valuation's not a problem. We're at a little over 18 times. Growth is the problem. And in fact, it's been difficult for small on the value and core side to outperform the larger cap stocks because the NASDAQ Sultans of SWAT have posted unbelievable earnings growth because of their IP, regulatory advantages, and network effects. Here is small relative to large, and small is getting cheaper and cheaper. In fact, we're back to the late 90s. This is obviously a positive. This is a potential catalyst. But what we need to see for small to really outperform value, small to outperform large, is for the relative earnings growth to come through. Those small cap investors on the growth side, which have strong earnings growth in their portfolios, will be able to outperform. Normalized valuation, in other words, looking at what typical earnings would be over a cycle, again, compared to history, small caps are not expensive. So it's all about earnings growth. Well, now let's talk about the opposite of earnings growth. Let's talk about loss makers. Public venture capital, which is dominant in growth portfolios, is now working very effectively. And in fact, loss makers, which is one representation of public venture capital, is now 30% of the Russell. This is up from 22% in the 90s. In the 90s, loss makers were often bad companies at the end of their life cycle. The loss makers in small caps today, particularly in the growth side, are purposefully designed as loss makers, as they are feeding into oftentimes the ecosystem of outsourced R&D by the large cap companies, and they're pursuing high gross margin and sales growth strategies in order to be able to show their value. And in fact, if you look at loss makers' returns in this public venture capital space, Russell loss makers have produced since early 16, they've been outperforming profitable companies 16% to 4%, the whole index by over 9%. Why is this? It's because it's a slow growth world where the world is in fact rewarding the things that we talked about. And in fact, we talked about intellectual property and how it's measured by gross margin. So let's look at loss makers when you measure by sales growth and gross margin. Since the first quarter of 16, the highest gross margin companies, the intellectual property, has produced 24% annualized gains. So that's going on 5 years versus a Russell that's produced about 8%. All loss makers have been dragged up by this good cohort and are outperforming. So if you're not paying attention to demographics, to interest rates, so you're owning the right duration assets, you've missed out on this. And if you have been looking for a cyclical recovery, you certainly have avoided these. Has growth gotten too expensive? Well, growth is expensive compared to where it has been in the past, but arguably it is not close to peak levels. But here's the problem for value. As growth has been more difficult to come and the return on savings and capital, et cetera, have gone down to zero, the growth companies are actually producing superior results to value. This is the average company's free cash flow in growth versus value, ex financials and biopharma. The growth index is producing far superior results and it's improving. So the point being here is that demographics are preventing the more cyclical value side from producing extremely positive results. Earnings growth. For those that are fearing there's going to be a strong cyclical value-oriented recovery, all you have to do is look at the sales growth assumptions of, let's go to this next page. Here, sales growth in 21 for value is forecast to be about 5%. On growth, it's going to be 10%. The action will be in growth, I think. Now, if you're a value-oriented investor and or you're a core investor, don't get apoplectic, because you can make money and outperform by inside of your benchmark, owning the growthier companies. In fact, we have done sector neutral work to look at these characteristics of gross margin and sales growth across the value, core, and growth area. And if you own the growthier companies, you outperform. The best just happens to be in growth. We'll start to move a little bit more quickly. What's the market telling us? Are we ready to mean revert? Well, the small cap market has been range bound. We're towards the top of the range. If you forget the pandemic market meltdown, kind of create a fold here, we've got a several year base that may break out. Growth has already broken out. That's your leadership. Value, not so much, hasn't broken out. In fact, it's just a little bit above the 18 lows. So how about risk? What I'll say here is everyone listening to this can probably enumerate all of these lists very quickly. The good news is the more visible and the bigger the risk, the more they're discounted. There are risks. Let's talk about FANG for a minute. And this actually is a look at the top 5. So it's Apple, Amazon, Facebook, Google, Microsoft. These companies are producing world-beating earnings. They have incredible IP, regulatory, and network effects. I referenced the beginning of 14. Since the beginning of 14, their relative performance compared to the S&P 500 has been quite unprecedented. And in fact, if you look at their percentage of the S&P, it's gone from 10% to 23%. And their valuation has gone from 10 times to almost, if you include Amazon, 40 times earnings or 30. The point I want to make here is if you're a small cap investor, it doesn't take much money to come out of these stocks in order for small caps to have a huge benefit. And in fact, the aggregate value of these companies is 9 times the S&P 600 and 3 times the value of the Russell 2000. Again, 5 companies are multiples of the value of either 600 companies or 2,000 companies. But these companies are producing world-beating growth and actually more free cash flow than the entire index. That can change, and in fact, someday will. The point of our presentation today is we're dealing with a world that is hobbled by demographic growth. We're dealing with a world where policymakers are doing everything they can to generate growth because they're scared of financial asset prices going down. Despite zero interest rates for a decade, they haven't been able to generate strong nominal growth or inflation. We don't see anything in the markets that tell us that we're going to see a major change in that. But let's end with one comment. We have been pursuing extreme fiscal policy subsequent to the COVID shutdown and economic recession. Should this level of extreme fiscal policy, meaning 10% deficits, continue after the economy recovers, we could see a change in the balance of economic demand relative to productive capacity that could change both nominal growth and where relative earning strength came and inflation. That could change favored asset durations that you own. We don't see it, but when we talked about the event change and where we could see change, this is it. So why don't I end there? And if I've gone over a little bit, I apologize, and happy to take some questions.
Great. Well, thank you, Jim. That was fantastic. No, I think we're pretty close to being right on schedule, so that was good. Number of questions have come in, and we had some kind of teed up from before. But given we're in the middle of October now, in an election year, 2 to 3 weeks away from a U.S. election, how are you? And recognizing, you're not a pollster or a political consultant, so not looking for a prediction, so to speak, on the election. But when you think of the potential outcomes, I mean, if it's a divided government, if it's a Democratic sweep, because I think the consensus thinking is that whomever wins the White House will likely take the Senate and control, if it's the Democrats at least, will then control Congress. So if the potential outcomes are, a divided government, Democratic sweep, or something close to the status quo and Trump wins and the Republicans maintain the Senate, how do you think about those sort of, the potential economic and market outcomes as a result of, of those 3 different scenarios?
So this is a very important question. And the way I'm looking at it and thinking about it is that it's all about the probability for extreme fiscal policy that comes out of the election. And ironically, I think each party, if given total control, will pursue the same policies. In other words, if it is a Republican-controlled White House and Congress, expect extreme fiscal policy with large deficits. If it's a Democratic-controlled White House and Congress, expect the same thing. However, in the US, our political system is so dysfunctional. Should there be divided government, each side will do everything they can in order to be able to prevent the other side from having success, even if it means not having an optimal outcome and pursuing policies that, if you were in power, would in fact be pursued. So it's pathetic, but that's the world we live in. And there's no more dramatic evidence of this than in what you're seeing with the extension of unemployment benefits before the election for the over 10 million people that are unemployed. So this comes back to what's going to happen in the election. And I have no real edge in being able to make the judgments as to who's going to win. But I do think that the simplistic view that it's going to be a Democratic sweep are overstated, because when you look at data around likely voters and you look at new voter registration data inside of key swing states, they tend to correlate more strongly with Republican positive outcomes than Democratic outcomes. So when you, meaning victories. So when you look at the political rhetoric, which I talked about earlier as something you should ignore, you have to recognize that that is all generated to turn out the vote, because the people that have the higher turnout are going to have a higher probability of winning. So to the degree that the Republicans are more energized than the Democrats, this could swing the election. Do I know what's going to happen? Absolutely not. But I do think the opportunity for a contested election and a difficult outcome is high, and kind of a best case scenario is being discounted currently. The other thing that's being discounted is extreme monetary policy continuing in a low growth environment. And the markets are telling us that, and it's supported, as we talked about, with the demographics.
Right. Well, and I think as we saw after the, the presidential, the one and only presidential debate, where, I guess Biden showed maybe more favorably than people were expecting, and you saw the election odds starting to move up more into Biden's favor, just in the kind of financial prediction markets, as well as the sort of aggregate polls that some of the political watchers sort of aggregate. And then, so even though Biden's odds started moving up, the market started rallying, and that proved not to be a headway or a headwind rather to market sort of growth. So I guess, how do you think that that's something that's sustainable in that, and by that I mean, is a Biden victory just as pro-market, pro-stock market as a Trump victory, or do you have a view on just how the market will respond to one of, just all leaving aside contested or not, stimulus or not necessarily, just do you have a view on that?
So periodically I write fiction essays, and those fiction essays are often seen through the lens of a guy I call Mr. Capital. And Mr. Capital views the world from the perspective of how he's treated. So he likes lower taxes, he likes less regulation, he likes market-friendly solutions, he likes rising wages for the average worker, and he likes high capital spending that creates better productivity. So the policy choices that we are going to see being made, I will view through the lens of a Mr. Capital. And if you look at the Democratic proposals, if you're a self-employed person, for example, living in California or New York, and Biden were to get what is on his website as what he wants to have passed for Social Security taxes and marginal tax rates, at $400,000, the marginal tax rate in the U.S. would go to 73%. $400,000 in a lot of the key economic states is not a lot of money relative to people who are looking to create capital, to create jobs, to create profits, to fuel a virtuous cycle in the markets. Similarly, if we pursue a Green New Deal that reimagines the way we build buildings and generate power, that too could drive up the cost of energy and be a tax and a burden on folks. So I think we have to measure the outcomes and the growth rates. The whole point of the presentation was that in the current environment, which has been relatively pro-growth, low tax, we have been unable to generate either significant real GDP or inflation. And if we put a higher burden on it, there'll be a balancing act between fiscal spending and after-tax returns and the animal spirits that CEOs and people who create jobs feel. One of the ways to look in the marketplace at the animal spirits of the market is through the velocity of money. It has been in a downtrend for many years, and it's something the Fed looks at as far as an inflation gauge. If we get policies that continue to keep a muted velocity of money impact, that's going to be a problem. The last time we saw a tentative move up in the velocity of money was in early 17 after Trump started to reduce taxes in the market's view and regulation. So there will be policy choices being made on a fiscal front that will be combined with monetary policy choices, and the outcome is going to produce growth and produce a favored duration of asset. I hope the policy choices are not damaging to growth, but instead positive to growth. But that's the lens I'm going to be viewing them through.
Right. And I guess just to kind of go back to one of those points that you made, I mean, whether it's a divided government or unified on one side or the other, is it your expectation that a stimulus package kind of gets passed relatively promptly post-election, because it seems as if it's getting caught up now just in election politics?
My expectation and the market's expectation is absolutely, and it will be large. And that's one of the risks to the marketplace, is if we get divided government and one side says ain't going to happen. So, you know, to put the current debate into perspective, we've got a recovering economy, particularly on the manufacturing side. The services side, which is more impacted by COVID restrictions, has been much less dynamic. So one of the things I worry about is the 21 economic outlook, when the services side, which is 2/3 of the economy, starts to feel the balance sheet and confidence impacts of this COVID recession. And so we do need stimulus, we do need effective fiscal policy in order to be able to get things going. And if instead we see higher taxes and more regulatory burdens, the services economy, particularly if it correlates with more shutdown activity because of COVID, will struggle. That will reinforce the growth side of the marketplace and the attraction of secular growth and small cap growth.
Yeah. Okay. Well, and actually, we've got some questions that we'll come back to that. But before we leave politics in the election, you know, is it your sense that the market is sort of expecting, or to some extent pricing in, a contested election? I mean, there's been so much talk about, you know, if it's the funding for the post office. If I saw some of the highlights of the Supreme Court justice nomination hearings yesterday, and there were a number of questions on, how would you rule if a sort of a contested election comes through. So there's certainly been lots of buildup and discussion around this, but is the market baking it in? How do you think the market responds if, in fact, a day in, a week in, we still don't have a final sort of decision on who won?
I think the market's discounting 3 to 5 days of counting absentee and mail-in ballots, but nothing more than that.
Okay, and is it fair to assume that markets tend not to like volatility, and so if this proves to be a more contentious sort of contest or a contentious sort of post-election process, that markets won't like it?
So I think the key is going to be the Senate. I think the markets will respond well to a divided Congress, because then we won't get as the potential extreme outcomes. And so if the House is, as would appear likely, continue to be controlled by the Democrats, the Senate has Republican control, the presidency will have a check on it. So as a result, that would be more of a continuation of current policy.
Right.
So the Senate may be able to be determined much more rapidly than the presidency. And so the markets, even if there's a contested election for the presidency, if the Republicans control the Senate, it may be a more market-friendly outcome.
Okay. And you touched on this a little bit before, but sort of, are there any market sectors that you think will perform, well, sort of regardless of the election outcome? I mean, just given this sort of macro backdrop that you've painted for us, that sectors that are sort of well positioned irrespective of the outcome?
Yes. And this has been where the wealth has been created over the last decade plus, the last 20 years. The markets historically, going back 100 years plus, have always liked what is new. And what is new tends to increase productivity and living standards. What's new is shiny. And so where we see the most dynamic change and improvement in living standards is occurring in healthcare as well as in technology. But you continue to see in healthcare, particularly in biotechnology, incredible intellectual property being created with regulatory advantages and network effects because of how drugs are sold being created. Most recently you had a company with 250 employees, MyoKardia, that got sold for $13 billion and has never sold a product. This is an example of public venture capital in a slow growth world where interest rates are low, value being created. If capital is very low cost and interest rates are low, to fund hundreds of millions of dollars of development costs has a very low opportunity cost. If interest rates at the other extreme, say, were 10%, and you had to fund $100 million in development every single year, that would cost you $10 million the first year, $11 million the next, et cetera, plus the $100 million. The point being is that not only you'd have a little bit more duration risk. So the economy is slow growth, but seeing incredible innovation in the areas that the market's rewarding with intellectual property, regulatory advantages, and network effects. And that's where you want to be. Because if we get very high nominal GDP growth, maybe it's that the fertilizer companies will be able to do well because inflation will take off, or industrial companies will be able to create surges. But this is also actually a very interesting point that I'm making implicitly. Active management, for those that are good portfolio managers, have a wonderful opportunity, as they've had, for stock picking to be able to add value. And it's not a surprise that in a turmoil-driven period like we've seen in the past year, Pembroke and other very talented managers are outperforming, because there is value being created, particularly in growth-oriented sectors and industries. So if you ask me to look out 3 to 10 years, I continue to like healthcare and technology the best.
Yeah, well, and we're aligned with you in that sense, both in Canada and particularly in the U.S., where technology is our largest end market exposure, and healthcare is right there around number 2 for us. And and we get, this is probably a good segue to some of the large cap tech companies, and a question we had there. We get questions about that all the time, because certainly the Apples and the Googles and Facebooks of the world, they capture the popular attention, and you see how well they perform. But I guess the reality is, as small cap managers, we've done a pretty good job of finding the little cousins of those businesses, not necessarily taking on the same markets, but levered to those same sort of massive secular drivers of digital transformation, globalization. I mean, all sorts of the factors that are driving technology. We just find them in smaller packages, but that they've grown in many cases just as well. But you've mentioned a couple of times that the technology companies are benefiting from this sort of regulatory regime and regulatory backdrop. And then so we had a couple of questions there. Just as the U.S. House of Representatives recently came out with a report that appears to be the first, or one of the first, salvos against the mass and the scale of these big tech companies. So the question is, how worrisome? Well, I guess, how worrisome is that for those mega tech businesses? And then, kind of importantly, when economic historians go back and they look at other periods where large companies dominated, as the tech companies are today, that period of dominance tended to end with regulatory action, as we're maybe starting to see now. And that when that happened, that actually shifted a narrative and a sort of dynamic in the market, going from large cap fascination to small cap outperformance. So I'm leading it a little bit, a long-winded question, but how do you think about that, the threat to the large cap, and could this be the start of potentially a sort of a shinier light on the small cap tech names?
So let's start with the premise that the world has never, ever seen companies of the scale and profitability and growth that Apple, Google, Facebook, Amazon are, those top 5 that we talked about. And what is so unusual is that the faster they grow, the more free cash flow they create, because of their high gross margins and their operating leverage. Amazon is the epitome of this, as people soon came to understand as they were first created. They actually had negative working capital, because they had every vendor whose goods and services they sold provide the inventory. So whether it's Microsoft or Google, these companies are producing free cash flow and growth that has never been produced before. And it has been premature to call for their demise, and they've gotten more and more expensive and maybe closer and closer to fair value. But it is only going to be the government that can take these companies on, because they have the market power to control their economies. No one can operate globally without these companies. Google is the epitome of it. They just have such a dominant position in online search. And if you have ever tried to buy online advertising, you certainly understand that. So that being said, every cycle runs its course, and governments do step in. Arguably, the House Democrats, this was a first attempt to be able to rein in these companies. but I like to think of them as they are hoovering up all the world's economic rent and profits, and eventually there will be repercussions. When that day comes, if money starts to move out, as I said earlier, those 5 companies represent 9 times the value of the S&P 600 and 3 times the entire value of the Russell 2000. Just a little bit of sale proceeds could move the needle. But also, if there are regulatory advantages that change their ability to dominate, it will open up end markets and opportunities for smaller tech companies and services companies to grow in a more open-ended fashion. So I'm not here to predict the demise of the mega cap companies, but to highlight how extreme it's gotten and the fact that when it turns, it's going to be powerful at the current time. But the world's never seen anything like this. And you want to be a stock picker when competing against them.
So maybe going back, there was the one slide that we've shown that you've created before that shows the long-term sort of growth versus value, and that value had kind of its day in the sun from 1941 to 2006 or so. But so a question related to that, and during that period of time, that 60 some odd years where value dominated, one of the hallmarks, as you show on the slide, is kind of an accelerated GDP backdrop. And by most accounts, 2021 is expected to be, just given how miserable 2020 is, a pretty substantial GDP growth year. But at the same time, as you've pointed out, inflation is low, interest rates are remaining low. So the question is the sort of GDP acceleration we're likely to see in 2021, is that sufficient to sort of drive a cycle for value, or does the sort of offsetting factors of lower interest rates, lower inflation, and some of these sector backdrops that you've mentioned, does that sort of outweigh that GDP growth?
So I agree with the latter. If you link the 2 years together and create what is a normalized growth outlook, you see that there is virtually no growth being created. And so investors are going to look through, I think, the temporary surge that's coming out. And that's one of the reasons why growth has retained its leadership and the secular growers have done well. That's not to diminish the chart that we showed earlier on a weekly basis where small cap growth versus value is going back and forth. I think that is all about the debate about whether or not we're going to go to extreme fiscal policy, which could potentially change the calculus of where relative earnings strength is coming from in the economy, and potentially change the favored duration asset if we get a surge in inflation. But as I said earlier as well, the manufacturing side of the US and global economy is coming back, but the services side has not. The services side is more impacted by COVID, and it's more impacted by business confidence. So if we get a vaccine that's effective and broadly used, we can assume the services side will come back, and then we'll look at an inflection point in regards to policy choices that are being made. But at the end of the day, we're dealing with the world's industrialized countries lacking population growth, and something we haven't spent a lot of time talking about is balance sheet capacity to borrow productively. And that is a function both of full balance sheets, where the only people with capacity to borrow really are the government entities, because a decade into negative interest rates in Europe and Japan, for example, and low interest rates in the US, the marginal borrowers have already filled up their balance sheet. But then we've also got this paradox of thrift issue going, where the very low interest rates keep people's risk taking down in regards to consumption, because they can't save easily for retirement. And as we age in the US, Europe, and Japan, people aren't looking to borrow more. In fact, as they age, they're deleveraging. So it's a long way of saying a strong cyclical recovery that could come out of a traditional recession is likely to be muted, just like the cyclical recovery coming out of 08 and then 18 were more muted than past ones. So you go back to that 65-year period where the value-led growth, you had high real growth, you had high nominal growth, you had periods of higher inflation and interest rates were higher, so the duration of the assets moved. The other thing that occurs is when there's economic volatility, and you go from slow to fast, you get a lot more market internal change. Right now, we've had periods of secular slow growth, which doesn't give the cyclical side of the economy an opportunity to shine. And because we've had secularly low interest rates, you haven't had a damning move away from long duration assets. Because make no mistake, there are areas of intense speculation in the market. One of the companies that I think is just ridiculous, and I don't know the fundamentals, but it's this company Snowflake, which is a cloud-based software company. I don't care how good a company you are, if you have hundreds of millions of dollars in revenues, so it's not like you're going to grow from an infinite base, trading at 170 times earnings, times revenues, is difficult to justify.
Yeah. Well, so we're running low on time. There was one point you made at the beginning of your response that I just wanted to come back to quickly because it sort of ties into one of the hallmarks of Pembroke. And as you said, the balance sheets, that there are a lot of companies that aren't in a position where they can sort of take advantage of, and this is implicitly what you're getting at, take advantage of this point in the cycle. And that they're over levered, they don't have the financial flexibility. And one of the kind of characteristics of a Pembroke company is strong balance sheets. I mean, we're quality growth investors. One of the key ways we define quality is financial flexibility and financial strength. And so in March and April, we went to literally all 110 or so of the companies that we own, and we asked them, how can you go on the offensive in this sort of period of crisis, and then importantly coming out of it. And the fact that I think in the U.S. our companies, they've got a little bit of net debt, but not that much. In Canada, it's roughly the same. In our concentrated fund, they're actually sitting on net cash. This is a historic time to be taking advantage of the opportunity, as difficult it is in some respects to sort of think of it in that sense, because this is obviously a horrible period for many. But this is where I think quality growth managers can really shine, because the businesses that we've invested in, they're not in that difficult spot from a leverage perspective. So anyway, I just wanted to throw that little plug in for our portfolios as a point relative to what you were saying. But we're a few minutes over at this point, but this was a fantastic conversation, Jim. Really appreciate your insight and your time, and I know our clients really enjoyed it. So with that, we'll sign off, but thanks again. And I think we've had a couple of questions as to whether the presentation can be made available. So just to reiterate, at the beginning, you said that was something we could do. So we'll certainly do that. And I think we also plan to post some of the highlights in a YouTube format at some point, so people can come back and look if they'd like to do that as well.
Wonderful. Well, thank you very much, Andrew, Ian, Darren, everybody at Pembroke. I appreciate the opportunity. It's an incredibly interesting and dynamic time. And I always like analyzing it and discussing it, particularly with thoughtful folks. And I think you guys are very well positioned. I said that back in May. It's been reinforced. And I think the secular outlook for true growth investors remains very bright.
We are in complete agreement. But thank you so much. Okay. And thank you to all of the participants that joined today.
Thank you, Andrew.
Okay, take care. Thanks again.
Bye.